Good afternoon, everyone. Thank you for joining us today. I'm Lina Iraqi, a senior tax associate at Auditor. Alongside me is Thomas Van Hee, our managing partner. We are both excited today to guide you through the discussion on the KSA and Qatar Double Tax Treaty. We are starting our webinar today at 2 p.m. in Qatar and KSA time. We will spend 1 hour to walk you through this topic. So this will be our agenda for today. We build up the agenda uh, to first discuss the domestic level, and then we will talk about the double tax treaty between Qatar and the KSA, as well as on the impact in these countries. Um, Among this, we will discuss the new trusted entity framework in Qatar, which allow the taxpayers to apply double tax treaty directly. Also, we will discuss the neutral transfer of asset within the group. Finally, we will touch upon the Pillar 2 overview in the GCC, including Qatar and KSA. So let's start now with the KSA tax regime. So from CIT perspective, the KSA mainly taxes companies with non-resident shareholding, as well as the PEs of non-resident. The standard CIT rate is 20% on net adjusted profit. The zakat payers will not impacted by that, so the shareholding of Saudi and the GCC nationals, instead of income tax, zakat will apply at 2.5% on the zakat base. Additionally, the Saudi Arabia imposes withholding tax on cross-border payments. The tax rate will range between 5% to 20% depending on the nature of the payment. VAT also apply 15%. The KSA also apply 15% VAT on taxable supplies of goods and services, if taxable in KSA. This is just a quick reminder of the KSA tax regime. So here we are discussing the scope of corporate income tax in KSA. Basically, we have these two categories. We are looking at first resident persons. They will be subject to 20% mainly. However, oil and hydrocarbon production will be subject to rates of 50% to 85%. On the non-resident persons part, we have this distinguish between non-resident with PE, who will be subject to 20% on the PE attributable profit. And we have the category of non-resident who generate income from KSA without having a PE. This income will be subject, as discussed, to withholding tax from on the percentage of 5% to 20%. Here an overview of or example of how the withholding tax will be applied. So basically, if a KSA resident pays fees for services received from a non-resident, this will be an income source in KSA. The withholding agent, which is the KSA resident payer, will need to comply with withholding tax regulation by first assessing nature of the payment to decide what is the applicable rate and remit the withholding tax amount to ZATCA, the tax authority in KSA, and file the withholding tax return, of course. So here, if we talk about the withholding tax scope, it is applied on payments made from KSA resident or a PE to a non-resident. So the services here, mainly the withholding tax will be applied on, as we said, on services and passive income. Services is defined as any work for consideration except buying and selling goods. In regard to the term of payments, it is defined broadly. So it's any consideration in kind or in cash paid, including settlement, accrual, set-offs, book adjustments, and liability. It's important to also understand that the withholding tax will apply to gross outbound payment value. This table shows the nature of payments and the corresponding tax rates. Now I'll pass the slides to Thomas to walk us through the Qatari side from the slides.
Thank you very much, Lena, and thank you very much for the introduction as well. And also on my behalf, thank you to everybody for taking the time to attend today. As Lena mentioned, what we wanted to do is first give a reminder of the domestic regime on both the Saudi and the Qatari side, to then discuss in a bit more detail what the effect is of the recently effective double tax treaty. For those of you that would want the slides afterwards, feel free to drop us an email. We'd be happy to share with you a copy of the slides as well. Now, if we move to the next slide, probably the point to focus on the most there is the withholding tax bit, because that's the bit that might be the most affected by the recently enacted and effective double tax treaty between Qatar and Saudi Arabia. As most of the attendees would know, but by way of a recap, right? Qatar levies a 10% corporate income tax on net adjusted profits and on PEs of non-resident entities. The different rates can apply in limited sectors. The important one is the 5% withholding on cross-border payments. We're going to come back to that in a second to show you again what the impact is of the treaty. As most of you would know, there is currently no VAT applicable in Qatar, despite the agreement between the GCC countries to implement this within effectively 2 years of the signing of the treaty in 2017. There is still no VAT like in Kuwait, but it seems that that might change fairly soon. We also have special regimes in Qatar, notably the QFC regime, where no withholding exists, and also a free zone framework, for lack of a better word, where the mainland tax regime does not apply. One element that we wanted to flag as part of this update for Qatar is next to the trusted entity regime, which is very beneficial for the application of double tax treaties, which is a fairly recent change. We also have now in Qatar a exemption for intra-group corporate restructurings. And essentially what this provision aims to achieve is that we have a so-called no gain, no loss transfer between group entities. And those group entities are defined as from the moment, or are in scope as from the moment that there's a 75% common ownership. And obviously the two entities need to be a resident in Qatar. So consider one mainland, so-called mainland entity with another one, and they are 75% commonly held. Then rather than having the capital gains due on a transfer of assets or shares in between two of those entities, under this provision, what you effectively have is that we, at the point of the transfer, apply an exemption. But obviously this is referred to as an exemption, but is in effect a deferral up until the asset is effectively going out of the group, or until the group ceases to exist. So where is this? What's this applicable to? Is to entities, for example, that exchange assets, assets which are contributed in kind in the capital of another company, mergers and demergers, but also importantly, the change in a group structure prior to a listing on the Qatari stock exchange. In other words, for the preparation of an IPO, we can apply the exemption on the gains which would be due by transferring the assets. So again, assets or shares. There's a couple of timing conditions as well that you can see on the bottom of the slide, which are in effect allowing the transferor and the transferee for the time to wrap up the transaction. And I won't go into all of them, but for example, when you look at the bottom, the listing effectively needs to be completed within 1 year. So if we move to the next slide, quite similar to the slides that we showed in regards to Saudi Arabia, you see here again the distinction made between resident persons and non-resident persons. On the left-hand side, generally a 10% corporate income tax rate applicable, but with higher rates for certain energy industries. And on the right-hand side, you see effectively the exact same mechanism as exists in Saudi Arabia, notably that when there is a permanent establishment, 10% corporate income tax applies on attributable profits. Whereas if there's no permanent establishment, then we have withholding tax at 5%, which applies. So in Qatar, we only have one single rate, although the scope of the withholding is less extensive than what you will find in Saudi Arabia. As mentioned a couple of pages ago, there's also the QFC in Qatar. We will not look into the impact of the double tax treaty in regards to the QFC, for the simple reason that the QFC does not levy withholding, and as a result of that, at least some of the articles of the double tax treaty, when it comes to the allocation of the taxing rights, do not apply. We see that effectively for the QFC, the rate is the same, but it applies on local sourced income, and there's a range of benefits and concessionary rates. So the focus of the QFC being effectively the financial services sector. We see that on income earned by investment managers, reinsurers, and captive insurers, for example, the tax rate is 0%. And also where the business is effectively held 90% by a Qatari national. And that is by way of equivalent to the mainland regime. Then quite interesting for investors, again, still for the financial services sector, is investment funds, holding companies, and special purpose companies. The income of those might be exempt. You can see, for example, that the participation exemption in the QFC is more beneficial than any participation exemption that you might find in the GCC, and potentially even beyond as well, given that the holding period in the QFC is only 6 months and not 12 months, as is more common. Further as well, so-called qualifying shareholding. So the capital gains on those qualifying shareholding defined as at least 10%. That is slightly higher than, for example, the 5% that you might find in other places, like the UAE, for example. But then also dividends and returns on public treasury bonds are simply exempt. Further, still in the QFC, we can carry forward our losses indefinitely, but we cannot carry them back. And there's also group loss relief available. A quick couple of words then about the free zones. Essentially, very limited amount of free zones, as in Saudi Arabia, where they're referred to as special economic zones as well, based on a 2005 law, where you effectively have the non-application of the income tax law for 20 years in total. Obviously, in regards to Qatar as well, what you'll find sometimes that there's individual concessions which are made, for example, in the defense sector or in the oil and gas sector, you might sometimes find based on either JV agreements or individual agreements with the GTA or with the relevant ministry, you may find corporate tax exemptions. Thank you, Lena. So the Qatari domestic withholding, so important here to note is one element which you find missing here, which are dividends, right? There's no withholding tax on dividends paid from Qatar. Similar to Saudi Arabia, the 5%, which is applicable, applies on gross payments. So payments made by Qatari residents, including government entities or Qatari PEs to non-resident persons. So what's in scope? Royalties, interest, and also services. When it comes to royalties, this is reasonably broadly defined, so not limited to simply intellectual property, but also the use of industrial, commercial, or scientific equipment, which is sometimes a wording that you might find back in the royalty definition under double tax treaties. Interest, generally subject to 5%, but within a range of exceptions. For example, government bonds issued, but also deposits in banks and financial institutions in Qatar. So generally 5%, but with exceptions. And then obviously services subject to 5%, and that's probably where we'll find the most application of the double tax treaty, where services are generally subject to 5% in Qatar to the extent that the services used or benefited in Qatar, with an exception for reinsurance, shipping, and maritime transportation of petroleum. So that's the scope of the Qatari withholding. I'll now hand back to Lena, who's going to be discussing the case at Qatar Double Tax Treaty, and then also the application from a KSA side. And then I'll come back to discuss the application on the Qatari side, but then also discuss near the end the application of the trusted entity regime and also the application of Pillar 2 in Qatar.
So we will start again with the double tax treaties in general from the KSA and Qatar perspective. So Saudi have signed more than 56 double tax treaties. Qatar has signed more than 75 double tax treaties. These double tax treaties will offer typically a more favorable tax treatment. However, to benefit from these reliefs under the double tax treaty, the persons covered by the double tax treaty will need to go through certain procedure and submit documentation. The double tax treaty specifics one of the two approaches to eliminate double taxation at the residence level. So either by the full exemption method, where the foreign income will be excluded from the taxation, or through the tax credit method. In this method, the foreign tax will be offsetted against domestic tax liability. Now we'll speak on the double tax treaty highlights. The KSA and Qatar double tax treaty was signed on 13 May of 2024, entered into force 1st of January 2025, and has been effective in 1st of January this year. Notably, this double tax treaty is based on both the UN model and OECD model, so a combination of both. Um, it has, let's say, a broad PE definition and will include anti-fragmentation provision that may explain a bit in the next slide. Typically, the KSA, for example, will have a force of attraction rule, which will widen the tax base for PEs. However, the double tax treaty between Qatar and KSA provide a protection from the domestic force of attraction rule. Um, while usually the technical services or generally the furnish of service will be subject or covered by Article 7, business profits. In this specific double tax treaty, there is an article, Article 13, covers fees for technical services. Such service fee will be subject to 8% in the source state. While usually if it's, for example, covered by business profit, an exemption will be granted. For the elimination of double taxation, KSA applies the ordinary credit method, and Qatar will eliminate such double taxation by an exemption method. This double tax treaty does not have anti-discrimination provision, so no protection against tax discrimination based on the double tax treaty. So in this slide, you can see the taxes covered in both countries as well as the persons. I'll focus a bit on the resident person definition. So it's defined as any person subject to tax in contracting state, so either in Qatar or in KSA, due to residence, place of management, place of incorporation, or similar criteria. This will exclude persons taxed only on income from source in that state and include political and administrative divisions, any entity directly or indirectly owned by the state, recognized pension funds, entity established solely for religious, charitable, scientific, cultural, or educational purposes. I would say this definition is particularly important because it's somehow the basis to challenge the application of double tax treaty. So it is important for a double tax treaty assessment. Moving to the permanent establishment definition under the KSA Qatar Double Tax Treaty. These are the five types provided or included in the double tax treaty. First, so if, for example, a non-resident has a fixed establishment, such as a branch or office, it will have a PE. If it has construction activities lasted for 183 days in the source state, it will also create construction PE. If non-resident sent its employees for more than 183 days into the source state to furnish services, it will also create services PE. And also we have the extractive PE for exploration or exploration of natural resources activities. The duration of such is quite limited, 30 days in any 12 months period. Additionally, if a non-resident have in the source state dependent agent, it will create agency PE. This is typically happen when dependent agent negotiate or sign contracts on behalf of the non-resident in the source state. So it's I talked previously about the anti-fragmentation rule provided in this double tax treaty. It is coming under Article 5. So basically, it's state that the time spent, the duration of each PE, but if it's spent by related companies, it will be combined to decide if such non-residents have a PE in the source entity or not. As typically double tax treaty, as the, typically in double tax treaty, the preparatory and ancillary activities are excluded from creating a PE. In this slide, we have slightly simplified the table to include key income only covered in the double tax treaty. We also have highlighted in orange the categories positively impacted by the double tax treaties. Let's take the business profits first. So it's subject to 5% in Qatar, and 5 to 20% in KSA, depending on the nature. But it's subject to an exemption under the double tax treaty. It can be noted that the dividends payment is not impacted because, as just Thomas mentioned, it's exempted in Qatar domestic level, and in KSA, it's subject to 5% equal to the offered rate by the double tax treaty. Interest, however, so the income, the interest income will be subject to 5% in both countries, but it is subject to exemption under the double tax treaty. So this is a positive impact, definitely. On the royalty side, it is subject to 15% in KSA, will be reduced to 8% as per the double tax treaty, but for the Qatari side, it's anyhow subject to 5%, so it's a lesser rate than what the double tax treaty is offering. For the most, I think, important category, fees for technical services, coming under Article 13 in the double tax treaty. If we're looking at KSA, it might be subject to 5 to 20%. In Qatar, it will be 5. In the double tax treaty, it will be it will يعني the source state is allowed to tax such income up to 8%, maximum by 8%. So, for example, to apply this in a practical situation, if the technical service is management services, it will be subject to 20% and then will be reduced to 8%. However, if it's technical and consulting services, domestically in KSA, this will be subject to 5%. So then the 5% will apply, 8% will not offer a reduced rate in that sense. Now, after having this overview of the double tax treaty provisions, we will talk a bit on how to apply and how this impacts the KSA. So to eliminate double taxation on the same income, Saudi Arabia applies a foreign tax credit or ordinary credit in cases where both countries have the right to tax the same income. The Saudi resident can offset withholding tax paid in Qatar against their Saudi corporate income tax liability. This is just basic wording. Of course, there is some formalities, documentation required to be submitted to apply such credit. Let's take this example. Example 1 shows a KSA resident company operate in both KSA and Qatar. In financial year 2025, the company generated a total gross income of 100,000 riyal, 60% of which was from KSA and 40% from Qatar. And the KSA resident company recorded 80% expenses. This results in a net income of 20,000 riyal. Again, the CIT rate is 20% and the Qatari withholding tax rate is 5%. Now let's apply these numbers and apply the credit principle. So assuming that there are no adjustments on the net income of 20,000 riyal, the CIT liability will be 4,000 riyal in KSA. The net foreign credit will be 8,000 riyal, meaning that the maximum credit allowed for the KSA resident company to apply against its CIT liability is 1,600. So if we have this KSA CIT liability of 4,000 and we have the credit granted of 1,600 offset from, we will have a net KSA CIT liability of 2,400. On the other side, when KSA is the source entity, a non-resident or like a Qatari company who generated income from the KSA and want to apply the KSA Qatari double tax treaties, it needs the cooperation of the KSA payer who will be applying for the double tax treaty application before Zatka on behalf of the Qatari supplier. It should be noted that there is a status of limitation of 5 years and there is a new portal application process. So usually what resident payer will do to apply for double tax treaty, it depends on the method, but it's either by email or through the return, the withholding return. But now there is this e-service link allowing taxpayers to submit their application through. We have two methods to apply the dual tax treaty in KSA, either the refund method, where the resident payer will need to withhold the amount paid to that can then apply for a refund, or the upfront relief. This process will be again through the return and no withholding tax will be paid. A quick example on this. So if, for example, Qatari-based company had given its subsidiary in KSA a loan and the KSA subsidiary is paying interest on this loan, the Qatari parent company does not have a P in KSA, and let's say that the interest amount is 90,000 riyal. Since withholding tax rate under the double tax treaty offering exemption on interest, although it is 5%, in KSA, net payment to Qatar company will be in full 90,000. The KSA resident must report the transaction in the monthly withholding tax return nonetheless and provide the necessary documentation to support this claim. Similar to other KSA double tax treaties, the double taxation relief measures do not impact the application of zakat and do not impact zakat payers. Now let's discuss, or Thomas will discuss with you the double tax treaty impact in Qatar.
Thank you very much, Lina. And may I say, very well done for a very first time that you're presenting for our firm. So congrats on that.
Thank you.
As Lina was saying, she has effectively addressed the Saudi part, and I will be looking at the Qatari part. Now, if we look at specifically the double tax treaty between Saudi and Qatar, what the DTT foresees is that there's a foreign tax exemption claim. In other words, the double tax relief in Article 25, usually Article 23 under the OECD Model Tax Convention, is in this case granted through exempting the foreign tax. Now, there is no guidance, unfortunately, on how to do this when Qatar is the residence state. So the only available option currently is to submit a manual application to the GTA and potentially discuss further with the GTA on the application. Just as a reminder, the treaty only entered into force on the 1st of January of this year, so there's very little experience with this. A very easy example of the application of the foreign tax exemption here is granted below. We've got a Qatari resident entity with income from a Saudi source. And let's say it's 100,000 riyals and 60,000 is from Qatar, 40,000 is from Saudi. Well, we will exclude the 40,000 from the base. So we'll calculate 100,000 minus the 40,000 and then calculate 10% on 60,000. Obviously, that 40,000 may or may not have been also subject to withholding in Saudi Arabia, depending on the type of income and the specific situation. If there would be a Saudi PE of the Qatari entity, then there's no credit granted, and the PE is subject to 20% on that Saudi sourced income. If we then go to the next slide, and I think this one is one of the novelties, which is really, really important to look into, and its application extends not just to treaties, not just to the treaty with Saudi Arabia, but to any treaty. And as Lena said, there's a bit over 75 treaties which Qatar has negotiated. As many of you would know, the application of a withholding tax refund claim in Qatar is a lengthy administrative process, which even at times ends up in dispute. And so up until very recently, we only had a refund method available. But last month, the GTA introduced something that we can refer to as the trusted entity framework. And effectively, in the same manner as we have in Saudi Arabia, a application at source, that's what this system effectively comes down to, but with a more limited scope. So in other words, the trusted entity may immediately apply the treaty in respect of the treaty applicable with the foreign entity, and therefore can immediately apply a lower rate, a lower withholding tax rate, or immediately apply an exemption rather than having to go through the refund mechanism. So this is very important given all of the complexities that many people have faced throughout the years. However, it comes with a number of conditions and strings. And I think one very, very important one is the threshold for eligibility, which is currently put at a fairly high level. So in order for you to meet the threshold to be a trusted entity in Qatar, in order to help the entity that you're paying to, you need to have had in the preceding year at least 1,250 transactions subject to withholding. And that's a fairly high number. And the other number is also fairly high, which is that you should have made 10 million Qatari riyals in withholding tax payments in the previous year. So the thresholds are high. So this is something really to consider. The trusted entity needs to look at this from their perspective, so it's not from the perspective of the beneficiary. And the GTA may, in addition to that, grant the status nonetheless to entities and bodies which do not qualify. Trying to read a bit into this, what we effectively are doing is we're experimenting a bit with it. We're putting the level fairly high in order for the amount of trusted entities applying for the capacity of trusted entity to limit those. What should we really be looking at is government entities, so all of the Qs, or large oil and gas entities, for example, all of those could potentially apply for this trusted entity status. Once the status is granted, it applies for 3 years and it can be renewed as well. Given that effectively there is quite some onus placed on the Qatari payers, there's strict penalties which apply for non-compliance. A penalty equal to the unpaid tax if it's not appropriately withheld, and then 2% per month for the delay in payment. So it could go fairly high, in addition to a 20,000 rial penalty per transaction. In other words, when you look at that penalty regime as well, we do anticipate that this is going to necessitate quite some discussions between foreign beneficiary and Qatari payors, potentially putting in place additional contractual provisions in order to mitigate and manage the risk. If we go to the next slide, the information which is requested for the refund method, we know that. Now, for the direct application of the DTC, you see below a simplification of the steps. We've left out one step, but essentially it is number one is your Qatari entity needs to apply to obtain the trusted entity status. Once that's approved, then the non-resident beneficiary also needs to apply with a form. And once that is approved, then the Qatari payors will have effectively a form which confirms that they can apply the double tax treaty rate, and then subsequently can apply that lower rate or no rate at all in the withholding tax return. When you review the amount of information which needs to be submitted, you will observe that there is a careful analysis of a range of information. For example, the contract reporting number needs to be included in the withholding tax return. There are certain questions raised around the substance of the entity which is benefiting from the payment as well, the foreign entity. So that the process requires more steps, more information, but obviously the flip side, if you can apply it, is that you don't have the cash flow, you don't have to run after the money for that long in Qatar. If we then go to the final piece of today's webinar, we just wanted to make sure that everybody has Pillar 2 front and center. And having that front and center means that we need to look a bit at timelines. Now, on this slide, what we've attempted to do is look at all of the 6 GCC countries and identify when the Pillar 2 rules apply and what the impact of that is. Maybe as by way of a first comment, as many of you would know, is that the Pillar 2 rules apply in the GCC mostly 1 year after the moment in which they apply in around 30 odd countries around the world. So broadly speaking, the EU, the UK, Japan, New Zealand, Australia, and a couple of other countries that kicked off in 2024. In the GCC, the Pillar 2 rules are starting 1 year later. And what you see is that while the legislation is fairly similar, there's small tweaks here and there or slightly different positions. So, for example, for Oman and Qatar, we have the application of the income inclusion rule, whereas for the UAE, Kuwait, and Bahrain, that option was not taken. When it comes to registration for Pillar 2 purposes, in most countries, the registration is not automatic. There needs to be a specific process followed, and mostly that process entails that there's a verification done on whether the local entity or entities are in scope of Pillar 2, whether they are constituent entities of an MNE group that fulfills the conditions. In Bahrain and Kuwait, this is normally due the registration within 120 days. Bahrain had for the first year a shorter deadline, and for Qatar, important for this for the attendees of this webinar, we expect the registration the registration form to become available in this quarter. This is not us saying this, this is the GTA saying it. Saudi, the other leg of today's webinar, has so far not announced anything in relation to their position with respect to Pillar 2. We know that discussions have been ongoing and legislation is ready, but let's say that the start button has not been pushed yet. Still on the previous slide in regards to the top-up tax return. So while the information return for 2024 is due in those countries that have implemented it by end of June of this year, so end of 2020, June 2026 for 2024. We are in the GCC only applying the Pillar 2 rules as from 2025. And as a result, we're looking at 15 to 18 months after 2025 for the return to be filed. The reason for this is a bit that in the chronology, you first file your corporate tax return, then you look into your CBCR effectively, for which some of those elements you need for the filing of the information return, and only afterwards we then have the effective filing of the QDMTT return, which is mostly what businesses in the GCC will be filing, and then subsequently the information return. Another maybe specificity in the region is that Bahrain has quarterly payments. This is quite uncommon. The other country that also has this is Belgium, but in the GCC, Bahrain is unique with this stance. Now, coming on to our last slide, if you look at the different charging provisions from Pillar 2, what you effectively see is that none of the GCC countries has applied the STTR. It's not a very common rule, but the STTR is the explanation on why the UAE has chosen a CIT rate of 9%. So it has indirectly had an influence. The UTPR has also not been implemented in any of the GCC countries. The UTPR is slightly controversial because it would tax the under-taxed income of the UPE country. So it taxes effectively a bit like the IIR profits from another jurisdiction. Now, all 5 countries that have implemented the Pillar 2 rules apply the DMTT. As far as I can remember, most, if not all, have the DMTT be considered as qualifying according to the OECD. And that means that effectively no IIR is due for the profits in that specific jurisdiction. And then, as mentioned, we have Oman and Qatar that apply the income inclusion rule, which means that if the UPE the parent is in Qatar or in Oman, and there's a subsidiary in a low taxing jurisdiction, then there will be a top-up due in Qatar and in Oman, respectively. With those comments, we come at the end. I should have probably put a picture of me and Lena at the end, but we were shy. We've come at the end of our webinar. I think we're bang on time when it comes to the timing. I would invite all of yourselves to, if you'd like the slides, to drop us an email. Invite you to subscribe to our YouTube channel, where we usually post all of our webinars, and to also follow us on LinkedIn. I hope you enjoyed today's session, and we'll come back to some of you that have individually asked some questions to us over the course of today's webinar. So thank you very much. Thank you again, Lena, as well, for the time that you've made. Thank you to everybody for taking the time today to attend. I hope you found it beneficial. I do think that there's, especially in Qatar, when it comes to the withholding tax refund, there's a couple of very interesting developments. Thank you very much for your time. Have a lovely day and stay safe. Thank you very much.